Hey everyone, Anthony Venuti with In Touch Mortgage Solutions. It's Friday, Finance Fridays, and on this episode, we're going to talk about the Bank of Canada hitting that pause button and what can cause the Bank of Canada to have to increase rates in the future. Stay tuned, you don't want to miss it. Early this week, we heard from the Bank of Canada regarding its decision to hold policy rates steady at 4.5%. And for many Canadians with a variable or adjustable rate product, this was a sigh of relief and a breath of fresh air. But this opportunity for the Bank of Canada to hold might be short-lived or might have some implications on what happens later this month in the US. So earlier this week, we did hear from Deputy Governor Carolyn Rogers on Thursday's press conference regarding the economy here in Canada. So some of the things that they pointed to were obviously that we're continuing the quantitative tightening, that the economy is still in excess demand. We are definitely having some flat growth or projections for flat growth over the next few quarters, and that's going to have some impact on businesses and reinvestment as well as wage growth, which is still elevated here in Canada. They also pointed to that the economy is basically stalling out and that we're still at a very relatively low unemployment rate of 5%, which is at odds with where the Bank of Canada wants to see unemployment, as well as we have to take into consideration that the Bank of Canada is forecasting that inflation will be back down to 3% by middle to end of 2023 and back on target by 2024. One thing that we are looking at very closely is obviously things that regard employment. These job numbers are still a major concern for Canada, especially when we look at what happened in January with 150,000 jobs. Obviously at odds with what the Bank of Canada needs to see in order to tighten up that labor market. Now, when we take a look at certain elements of the economy, obviously CPI, inflation being the most important or the front runner on the Bank of Canada's policy rate decisions, while we've seen a drop in those numbers, obviously they came in January a lot lower at 5.9%. So that's something that we're going to be paying close attention to, as a lot of the actual inflation numbers, which are stripping out food and energy, are definitely coming down month over month. Now, when we look at these numbers, what do they actually tell us? Well, a lot of conversations are happening around household spending. Household spending not only for consumer goods, but where is the money at the end of the month going for Canadians between the rent and their mortgages? So consumer debt is a very important part of the Bank of Canada's decision. And in the last rate announcement, when we heard the Bank of Canada go up 0.25% just in January, a lot of conversations around the consumer debt load actually influenced the Bank of Canada's decision to not be as aggressive and potentially to continue this holding pattern. The question is how long can the Bank of Canada hold on? Obviously, the data is telling us that if the economy continues to operate, inflation continues to come down, GDP growth, economic growth continue to stabilize, and if they come in lower, obviously these are things that could point the Bank of Canada in a position to hold or in this holding pattern. But one thing I'm looking at is what is happening in the US, and obviously this is a big conversation amongst economists. So some economists for Canada are predicting that we could see a 0.25% increase at some point throughout 2023, if not more, based on certain economic conditions. Now, it's important to understand just because the Bank of Canada is holding in March, it doesn't mean that it's going to hold for the rest of the year. There is still a lot of volatility with a pending recession, or how difficult or how hard this recession will hit and how that will impact the Canadian landscape. But when we look at what is happening just on the other side of the border in the US, earlier this week we heard from the head of the Federal Reserve, Jerome Powell. And as the head of the US Federal Reserve, the most influential and powerful central bank in the known world, well, obviously they have some different conversations. The US is indicating that the potential for an increase to their policy rate on March 20th and 21st of this month could definitely put the US Federal Reserve and the Bank of Canada at odds. And those increases to the US Federal Reserve or to their policy rate will have, a trickling effect on the Canadian economy. So the way that that would work is that if the US increases their policy rate significantly higher than Canada, so let's take a look at 4.5% here in Canada, they're at 4.75% in the US. Projections and economists are stating that the US might increase at a minimum of 50 basis points, potentially even more, as it will aggressively continue to tackle inflation by increasing its policy rate. If the gap between the US policy rate and the Canadian policy rate is too wide, well, that's going to have a downward pressure on the Canadian dollar. And the Canadian dollar, when you look at foreign exchange, is a very important matrix for what the Bank of Canada is going to look at for inflation. So why is that important? Well, let's take a look. As the Canadian dollar continues to make its plummet towards 70 cents or 71 cents, well, that means that the US dollar, because they're increasing, is gaining strength. Ours is coming down as opposed to the US. And that makes the cost of purchasing US goods more expensive for Canadians. And if you're purchasing US goods at a weakening dollar, well, now you're paying more for the same goods you were paying just last month a little bit less for, and that increases the inflationary pressure. It stokes inflation. And you're importing inflation because of that. Now, obviously, there are some pros and cons to a weakening dollar, and that conversation is that if our dollar weakens, well, we look more attractive to other countries who are looking to purchase Canadian goods. But the majority of our trade is done with the US back and forth. So the central bank, even if the Bank of Canada is in a position right now where they may be able to hold out on a few different increases throughout the course of 2023, the direction or the trajectory of the US can impede that ability for Canada to hold that button for that much longer. So if the US increases, the Bank of Canada may be forced to have no choice but to actually have to move alongside, or at least not in 100% lockstep with the US, but at least to close that gap a little bit. Now, this is the major purpose for this video, is a lot of Canadians were getting phone calls from them saying, hey, Bank of Canada is hitting the pause button. They didn't move interest rates. Hey, now is the time to maybe re-emerge into the market. Interest rates are definitely going to, level off, but there's still a lot of uncertainty in the market, and we're not out of the woods just yet. So it's very important to be very cautious about your finances, especially when we look at consumer debts. Canada is very, very susceptible to interest rate increases, as we've seen to household spending, as that is still a major sore spot for many Canadians who've had variable rate mortgages, and they've seen those payments skyrocket. But the other additional, flame to the, or fuel to the fire, I should say, is those Canadians who are approaching mortgage renewal in 2023. Those Canadians who got a mortgage in or received a mortgage in 2018 are going to be approaching their renewal if they took a 5-year fixed in 2023. And when you look at the rate differences, there are going to be some payment shocks. And as Canadians now are starting to get their renewals, a lot of them are starting to take on shorter term mortgages, which definitely meet the criteria to help, situate Canadians today. But if interest rates don't level off in the next few years, well, that could obviously have, a spillover effect in the next few years. In opposition to the US, so this is one of the questions that we've been talking about, is what really differentiates the mortgage market here in Canada as opposed to the US? And generally, mortgages in Canada, the most popular products just a few years ago was the 5-year fix. Now it's moving to the 1 to 3 year. In the US, the general mortgages are 15 to 30 years. So the payment shock on their end is obviously a lot less than here in Canada. Now, that brings us to what is happening here in Canada. And as we hear from a lot of the banks who are putting aside a lot more money to potentially cover those losses in bad loans, while obviously it is OSFI, the Office of the Superintendent of Financial Institutions, that's mandating that these banks put this money aside, these provisions. Now, whether or not these actual defaults will come into play is another question as we continue to make our way through 2023, and if interest rates remain elevated for an extended period of time, how many Canadians can hold on, who is going to be forced to sell their home. Obviously, the market with lower inventory, prices might begin to stabilize. We may have hit the bottom. We may have not hit the bottom just yet. Obviously, we are starting to see some different trends evolve from January to February and now in March. So if inventory remains relatively low And we've just talked to a whole bunch of clients who are looking at properties. And one client in particular that came to light was an open house on the weekend that saw 30 showings or 30 booked showings on the Saturday, 40 on the Sunday, followed by 9 offers to sell over ask on the Tuesday. On the Monday. And this was something that was very, very interesting to me because we're starting to see things change in the market. Now, obviously, not all the markets are going to be the same. Certain locales are going to have more action than others, and certain homes with certain price points are going to have more traction than others. A lot of the homes that we're seeing are those homes listed at sub $1 million because there's more buyers that can actually enter that pool. Because if they don't have 20% or they can buy with an insured mortgage, less than 20%, well, those homes priced below $1 million are going to get more first-time home buyers and more new to Canada individuals in the market or looking at those homes. And something that I'm hearing not only from clients but from other agents is that these homes are priced relatively low to where their current comparables are selling for. So we have to keep this in mind. A lot of information around what the Bank of Canada is doing, the stability, maybe a false sense of stability until we see what unwinds not only here in the Canadian economy, but more importantly, what ends up happening in the US economy. If the US increases its policy rate 50 to 75, even 1% in one go, bringing their policy rate to closer to 6%, and then they hold for the remaining portion, well, that could change the dynamics moving forward. Obviously, as I said, volatility, very important. We look at the potential for the fixed rate mortgages, something we talked about last week. And since last week, we've seen an uptick of anywhere from 15 to 20 basis points in those insured and uninsurable mortgages, tick up a little bit higher over the course of the week. And with the recent announcement on Tuesday from the US Fed, as well as what the Bank of Canada indicated on Wednesday, well, there's still going to be some uncertainty in those fixed rate mortgages until the bond market actually is able to get a grasp or sink its teeth into what actually the data means. And this is something that as Canadians who are approaching the renewals or looking to purchase a home, we're advising our clients to sort of get that pre-approval locked in right away. And if you're approaching the renewal, is talk to your mortgage professional, see what rate they can secure for 90 or 120 days so that you're betting against increases to future rates, especially if you're approaching that renewal. So there are different things that we are looking at, and not to mention one other important factor that is obviously manipulating the data when it comes to foreclosures or power of sales and all these distressed sales. And something that CIBC came out with just last week was obviously something that we even talked about on this channel months ago, was what they're doing with their mortgages, extending that amortization well above the 30-year mark. They're basically holding clients with their mortgage payments. Let's say they're coming up for renewal or they're not able to make those payments. Well, they're adding in that interest because those trigger rate mortgages, a lot of clients with the recent increase in January might have breached their trigger rate. And now that they've done so, most of that payment, if not all of it, is actually going towards interest and nothing is going towards principal. And a lot of the banks are just absorbing these mortgages, re-amortizing them, extending them onwards and upwards. And this is obviously creating a floor right now in the mortgage environment, because if all these lenders are doing the same thing, well, you're not going to see this wave of homes hitting the market just yet. But once again, you're kicking the can down the road. Maybe not today, but maybe in the future if interest rates remain higher for longer. Well, how much longer can many Canadians actually hold on for? Let us know in the comment sections below what you think. What do you think will happen on April 12th when the Bank of Canada meets again? Are we going to see the Bank of Canada increase policy rate in April, or will it be again in June? We'll leave the video here, and we hope that you found the video interesting or learned something from the video that you didn't know coming into it. But thanks again for watching, thanks for clicking, and we'll see you again next Friday.